Beyond the buy and hold, deconstructing the real engine of wealth compounding, we often hear it, don't we? That simple mantra, buy and hold, it's presented as the golden key, the ultimate strategy for wealth compounding, a path paved with predictable, steady growth. It sounds so straightforward, almost soothing in its simplicity. But what if the devil, as they say, is truly in the details? What if the real engines of wealth compounding are far more nuanced, far more intricate than this popular narrative suggests? Today, we're going to gently unpack the illusion of simplicity that often surrounds basic compounding. We'll peel back the layers, not to dismiss the idea entirely, but to reveal the hidden complexities, the critical strategic layers that truly separate stagnant portfolios from exponential growth. Think of it like this. Benjamin Graham, in his timeless wisdom from The Intelligent Investor, taught us that an investor's primary task isn't just to buy a good business, it's to buy that good business at a good price. Similarly, compounding isn't solely about the act of holding. It's profoundly about how you hold, when you hold, and crucially, what other deliberate actions you take alongside that holding. This journey is not about chasing ephemeral dreams of getting rich quick. Far from it. Instead, we embark on a rigorous dissection. We will explore 6 advanced strategies that, when understood and applied, truly unlock sustainable, long-term wealth accumulation. Our aim is to move you from being a passive participant, a spectator in your financial journey, to becoming an active, informed architect of your financial future. Are you ready to look beyond the basics? Strategy 1. The Reinvestment Cascade. Beyond simple dividend reinvestment. The conventional wisdom often tells us that reinvesting dividends is the cornerstone of compounding. It's a familiar, comfortable idea, a single stream of returns flowing back into the existing investment. But what if this simple act, while beneficial, is merely the first step? The reality is, a true reinvestment cascade involves a much more sophisticated and strategic reallocation and optimization of all returns, not just dividends, to truly accelerate your compounding. Imagine a vast river system. Simple dividend reinvestment is like a single stream, dutifully flowing back into the main channel. It adds volume, yes, but its impact is limited. Now, picture a reinvestment cascade. This is a complex network of strategic diversions, strategically placed reservoirs, and gravity-fed channels, all designed to ensure that every single drop of profit is meticulously channeled for maximum downstream force. It's about harnessing momentum, not just adding volume. Here lies a hidden truth that many investors overlook: the subtle, yet significant, impact of tax implications and opportunity costs when you simply tick the reinvest box without deeper consideration. Are you aware of how capital gains taxes might be silently eroding your returns? Have you considered the power of tax loss harvesting to offset gains, or the strategic advantage of reinvesting those returns into different assets that might offer superior growth potential? This is the essence of the cascade, a dynamic, intelligent flow. So, let's bring this home. Take a moment to analyze your current portfolio's reinvestment strategy. Are you truly maximizing efficiency by considering the tax drag and the potential for cross-asset allocation? Or are you, perhaps unknowingly, leaving significant compounding potential on the table, like a river flowing through a partially blocked channel? This strategy transforms basic reinvestment from a passive tick box exercise into a dynamic wealth-building machine, ensuring every dollar earned is working harder and far smarter for you. This is where true wealth begins to build upon itself. Strategy 2. The economic moat fortification, compounding through sustainable competitive advantage. The premise here is fundamental. Truly sustainable long-term wealth compounding is intrinsically linked to the enduring strength of a company's competitive advantage. Its so-called economic moat. Owning a piece of a business is a powerful act, but simply owning a stock, any stock, is not enough. To compound wealth effectively, you must own a business that is not just profitable today, but is fundamentally built to last and to grow, year after year, decade after decade. Consider, for a moment, companies like Coca-Cola or Microsoft. We can analyze their current profits, of course, but their true enduring power, the engine of their compounding wealth, lies in the factors that allow their earnings power to compound over decades. These are the intangible yet formidable elements: the unshakable strength of their brands, the powerful network effects they command, the sheer switching costs that bind customers to their ecosystems. These moats allow them to defy economic cycles, protecting and amplifying their profitability. Now, let's debunk a common myth: the idea that growth stocks will always outperform. While growth is certainly desirable, compounding is most potent and sustainable when it is underpinned by a widening economic moat. This moat acts as a shield, protecting profits from the relentless pressure of competition. It allows the company to consistently reinvest its earnings at high rates of return, creating a virtuous cycle of growth and value creation. Without this protection, even rapid growth can be fleeting. The practical application, then, is to learn to identify the key components of an economic moat. This requires looking beyond the surface surface-level numbers in financial statements and delving into the underlying business dynamics. What truly gives this company its durable advantage? How strong is it? And how durable is that strength likely to be in the face of future challenges? By mastering this, you shift your focus from the ephemeral dance of short-term price movements to the fundamental resilience and intrinsic growth potential of businesses. This strategy allows you to build wealth on a bedrock of sustainable competitive advantage, a foundation far more secure than shifting market sentiment. Strategy 3. The capital allocation alchemy, turning earnings into exponential growth. The core concept we're exploring today is profound. The quality of capital allocation by a company's management is arguably the single most significant driver of long-term shareholder value and, consequently, compounding wealth. Even the most robust, promising businesses can have their wealth-generating potential utterly destroyed by poor allocation decisions. Conversely, astute capital allocation can transform even modest earnings into exponential growth. Think of a master alchemist. This individual doesn't merely mix ingredients haphazardly. They possess a deep, almost intuitive understanding of the precise ratios, the critical temperatures, and the intricate processes required to transform base metals into gold. Capital allocation, in the context of business, is precisely this alchemical process. It is the art and science of transforming a company's earnings, its raw material, into superior shareholder returns, into true gold. Here lies a hidden risk that many investors unfortunately overlook. We tend to focus intently on what a company earns, on the headline profit numbers, but we often neglect to scrutinize how management chooses to deploy that hard-earned capital. Consider the options: dividends, share buybacks, mergers and acquisitions, research and development investments. Each of these actions has a unique compounding impact, and any misstep, any poorly conceived decision, can be catastrophic to long-term value creation. To navigate this, we need an analytical framework. We must develop the ability to assess management's capital allocation prowess. This involves looking beyond surface-level metrics and examining trends in key indicators such as return on invested capital (ROIC), the efficiency of their share buyback programs, and the historical success rate of their mergers and acquisitions. By understanding these, you can begin to discern which companies are truly compounding shareholder wealth and which are merely reporting profits without effectively growing value. Mastering this capital allocation alchemy empowers you to identify businesses where management is actively working to multiply your investment, not just tallying up earnings. Strategy 4. The compounding diversification, concentration with calculated risk. The premise we explore now challenges a cornerstone of conventional investment advice: diversification. Traditional diversification, while valuable for reducing overall portfolio risk, often has a predictable side effect. It can also dilute potential returns. Our approach, compounding diversification, flips this on its head. It involves strategic concentration in your highest conviction ideas, but crucially, this is balanced by a robust framework for actively managing and, in fact, leveraging risk. Let's touch upon scientific concepts, drawing from portfolio theory, but moving beyond simple correlation matrices. We need to understand how carefully selected assets, those that are uncorrelated or strategically correlated, can, when held with genuine conviction, amplify your compounding potential. It's not about random spread, it's about intelligent synergy. It's about building a portfolio where the whole is truly greater than the sum of its parts, not just for safety, but for accelerated growth. This brings us to a myth that needs debunking: the notion that the more you diversify, the safer you are. While safety is a valid concern, the truth is that over-diversification can often lead to mediocrity, a portfolio that never truly excels. Conversely, concentrated positions, those built on deep research and conviction, when managed with unwavering discipline, offer the potential for truly outsized compounding. It's about calculated bets, not blind gambles. How do we implement this practically? We learn to construct what's known as a core satellite portfolio. This involves identifying those few high-potential satellite investments that can drive significant returns, while maintaining a stable, broadly diversified core that provides a solid foundation. We will discuss the critical elements of position sizing and sophisticated risk management techniques specifically tailored for these concentrated bets. This strategy, therefore, redefines diversification. It transforms it from a mere risk-averse blanket into a calculated, powerful lever for accelerated wealth accumulation. It's about intelligent concentration, not reckless scattering. Strategy 5. The time arbitrage, exploiting market inefficiencies through patience. At its heart, this strategy is about understanding a fundamental truth of markets. They are not always perfectly rational. The market often misprices assets, not because the underlying value has changed, but due to the fleeting forces of short-term sentiment, the ceaseless churn of news cycles, or deeply ingrained behavioral biases. Time arbitrage is the elegant strategy of patiently holding assets through these temporary dislocations, allowing their intrinsic value to compound and, inevitably, to be recognized. It's about riding out the storm. Let's recall a real story, a narrative that illustrates this power. Consider the remarkable long-term success of value investors who had the foresight and the fortitude to buy during periods of widespread panic. Think of the depths of 2008 or the initial shock of early 2020. Their true genius wasn't just in identifying undervalued assets, it was in their unwavering patience. This patience allowed the underlying compounding power of their chosen assets to eventually reassert itself, often yielding extraordinary, life-changing returns. They understood that time was on their side. Here lies a hidden truth that affects so many. Many investors become victims of time arbitrage themselves. They sell too early on genuinely good investments, cutting short their compounding potential, or conversely, they cling to poor performance for too long, hoping for a miraculous turnaround. In doing so, they are effectively giving away potential gains, allowing more patient market participants to capture the rewards. It's a subtle, yet incredibly costly dynamic. This requires an actionable mindset shift. We must cultivate the psychological fortitude to resist the siren song of short-term market noise. Learn to identify those critical situations where market sentiment deviates significantly from intrinsic value. Then, position yourself to benefit from the inevitable and often powerful reversion to the mean. This strategy hinges on a profound understanding that true exponential compounding often requires an extended runway. Patience, in this context, is not merely a virtue. It is one of the most potent financial tools at your disposal. The 6 pillars of exponential wealth, from basics to mastery. We've journeyed together, moving far beyond the simplistic, often misleading, notion of merely buy and hold. We've deconstructed the real engines of wealth compounding, uncovering 6 advanced strategies that form the bedrock of sustainable financial growth. We explored the reinvestment cascade, transforming simple reinvestment into a dynamic force. We fortified ourselves with the wisdom of economic moat fortification, understanding that enduring competitive advantage is key. We delved into capital allocation alchemy, recognizing that how management deploys earnings is paramount. We redefined diversification through compounding diversification, embracing concentration with calculated risk. And finally, we embraced time arbitrage, harnessing the power of patience to exploit market inefficiencies. These are not isolated tactics, mere bullet points on a checklist. They are interconnected pillars, each reinforcing the others, that, when integrated thoughtfully, create a robust and powerful framework for sustainable, long-term wealth accumulation. Think of it, as Warren Buffett might suggest, like rolling a snowball down a long, steep hill. The trick isn't just to start rolling, it's about ensuring you begin with a good snowball, a sound investment. It's about having a long hill, a sufficient time horizon, and crucially, it's about ensuring that snowball gathers more snow, more value, at every turn through intelligent reinvestment and strategic growth, all while preventing it from melting away due to poor allocation or flawed strategy. The journey to true financial mastery is, and always will be, a continuous one. It requires more than just knowledge, it demands application. Take these principles, integrate them into your thinking, and allow them to guide your decisions. Remain intellectually curious, always seeking to deepen your understanding. Remember, true compounding is a marathon, not a sprint. It is built not on fleeting emotions or market noise, but on a foundation of informed decisions, unwavering strategy, and a profound respect for the power of time and intelligent action. What step will you take today to begin building your own exponential wealth?